Hello, this is Jim Hiles from First Capital and Goal Plan 101. We're going to be talking about taxes, a Tax Tuesday. Let's look at the episode, and we're going to be talking about a number of things here because I've gotten some questions on a number of issues. Looking for your deductions, certainly your mortgage interest, and you go up to $750,000. So that's what you can do your mortgage interest against $750,000 of mortgage debt. One thing to look at here is that they're in the Senate, I believe, right now, and they're talking about increasing the SALT deduction. That might have something to do with it, so keep your eye on that. If you have a home equity loan, then certainly you can deduct that as well. Again, just make sure that you're not going over these values so that you can get the deduction, full deduction for the interest rate. Points, if you're taking a mortgage, look at those purchase discount points as a way to lower your interest rate. So we do like those. If you're looking to refinance, you can deduct the cost of those points. Property taxes, again, you're still subject to SALT. $10,000 here is certainly limiting in the Northeast. Again, look for the changes that potentially could happen here. They seem fairly likely that something will change in terms of the SALT deduction. In terms of home improvements, look for things that qualify for home improvements that you can add in. These are permanent improvements. So one of the things you look at here, and we'll talk about in a second, is you want to make sure you track cost basis on your house. That way you can increase or decrease the potential capital gain on the house in the future. Home office expenses, if you work from home, which a lot of people have been doing here, then look at a home office expense on your tax return. Mortgage interest, PMI, private mortgage insurance may also be deductible on your itemized tax return. Capital gain taxes, be aware that you will have capital gains on the sale of property. If you're selling your house and you've had it for 2 or 5 years, you've lived in it for 2 or 5 years as a primary residence, you can shelter for a married couple $500,000 from capital gain tax. It's a pretty significant deal. So what we all ought to be doing here is buying and selling a house every couple of years. Just kidding. It might work for some of you, but not for me. But it is something to keep in the back of your head when you are thinking about your real estate and how you want to maximize this exemption, which only occurs on a primary residence. Capital gain taxes, you're going to be doing offsetting gains and losses. I've talked about that a lot in the past. That's kind of what you want to do. So those are some tax tips for Tax Tuesday. Jim Hiles signing off for now.